The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Scott Earhart here with Insurance Agency Marketing Services. Do want to thank all of you for taking time to join us here today. I am super excited about the information you're going to hear today. Today we are going to take a look at Athene's Benefit 10 product, probably one of my all-time favorite products that Athene has ever put out, and for that matter, any company has ever put out. It's truly a Swiss Army knife type product, and they've made some enhancements to it here very recently. So I'm excited to be talking about it again. In order to take a deep dive into the product itself, we've got our relationship manager with Athene here on the line with us, Mr. Mac Campbell. Mac, can you hear us?
I can, Scott. Thank you for having me today.
Hey, thank you for the time. I know it's super busy right now, wrapping the year up at Athene, so we really appreciate you giving us a bit of time today. Before I do hand it over to Mr. Campbell, I am going to go through just a couple of housekeeping items and then jump into some introductory slides and then get into the meat and potatoes of the presentation today. So first housekeeping item, and probably the most important thing you will hear come out of my mouth today, is in the top right hand side of your screen. That is our phone number. It is 800-255-5055. If there is anything that we can be doing to help you in your business efforts, please do not hesitate to give us a call. We'd absolutely love the opportunity to be working with you. Second housekeeping item are polling questions. Throughout the presentation today, I should launch a total of 3 polling questions. They are simply yes or no questions, so if you would please take the time to participate in those, we'd certainly appreciate that. And then final housekeeping item are going to be questions. We're going to throw quite a bit of information at you here in a relatively short period of time, so I'm sure there will be questions. Feel free to type them into the questions box. Mac himself and actually the entire culture at Athene do an amazing job of being as transparent as corporately possible, if that's a term. So we'd love to try and answer any questions that you have. We'll do the best we can to get them answered here live in session. And if we don't get them answered live in session, certainly I will do the best I can to get them answered in a follow-up. That being said, let's jump into some introductory slides, and I want to start with IM's Business Builders. First one on the top of your screen there is a referred producer program. Our business here on the wholesale side of the industry is very similar to yours in the field, in that one of the best leads we can ever obtain is a referral from one of our valued clients, or you, our valued producers. So we want to make it worth your while. When you refer an individual over to us and they pick up any license through Insurance Agency Marketing, we're going to send you a check for $50 as a thank you. Now, where the real money comes in is we're going to give you a 20 basis point override on the business that your referral writes. So can be very, very lucrative. You see the example there. Steve and Charles, our ownership group, sign those checks at least quarterly, and they do sign checks for thousands and thousands of dollars at a time. With that in mind, if you know of anyone who might be able to utilize our services, could benefit from working with IMS, please email me their information, scott@imsinc.com. Feel free to type it into the questions box there, or when I call to follow up, let me know who they are. Myself or someone on my team will do the best we can to get them recruited over to us here at IMS and hopefully get some referred producer dollars in your pocket. Next business builder, and probably our most popular program that we have here at IMS, is marketing reimbursement. Rough numbers on this: for every $100,000 in premium that you place through IMS, we are going to put $100 into your marketing reimbursement account. What makes marketing reimbursement so very lucrative is that we put very few restrictions on it. Excuse me, guys. I got a bit of a frog in my throat. We put very few restrictions on our marketing reimbursement. Basically what that means is we're not going to cap your account. We're not going to tell you when you have to roll that account out. Also, we're not going to put many restrictions on vendors that you can use for that. Basically, all we're going to ask is that you submit a receipt to us, and then we'll cut a check same day. Hopefully, get it out to you overnight and help you offset that expense. Mr. Campbell, if you're still with us, I'm going to switch this up a little bit. Apparently, I have decided to get a big frog in my throat here. Would it be okay if I gave you control and we just jumped right into it?
Let's do it. I'm ready, man.
All right, buddy. I'm going to give it over right now.
Okay, great. Well, if you're able to hang with us there for just one more quick second, Scott. If you can see the slide and hear me okay, let me know that. I'd appreciate it.
Yep, I can see the slide and I can hear you just fine, bud.
Okay, great.
Thank
All right,
you.
well, look, hope you feel better, man. That was on the way to being a great introduction, I could just tell. No, but anyway, and by the way, I love that corporately possible comment too. I'm going to start integrating that into my presentation, so that's good stuff. So, hey, listen, everybody, first of all, thank you for being with us today. I know we all are having likely very busy weeks trying to wind down, our offices, our practices, our holiday shopping, who knows what else. I have yet to start mine, which is true to form, so hopefully we'll get that done here by the end of the week. But it means a lot that you've decided to take about 30, 40 minutes of your time this week in particular to join us today. And as Scott mentioned, we're going to be talking about, one of the most overlooked products in our portfolio. As Athene has grown over the years, I think if you were to take a step back and look at the portfolio that we have, it truly is one of the more comprehensive annuity portfolios from any one carrier in the business. When you look at what we have and what kind of solutions we try to deliver to you for your customers, we have products that will generate income for people during retirement. We have products that will accumulate incredible amounts of money for your clients when things are looking good in the markets, and frankly do that in a safe way. We have protection type products, multi-year guarantee type products, and then of course legacy. And what I love about the Benefit 10 in particular, and you mentioned that Swiss Army knife, here's a picture of a Leatherman, sort of kind of the same concept, is this product is designed for someone that really for most people, if you think about it, most people will need income at some point. I think we can all agree on that. Most people will likely, whether we want to admit it or not, need some sort of home health care or enhanced benefits, kind of like a long-term care benefit during their lives. As our population is aging, I know both of my grandparents have, and one of my parents is already in that situation. So it will happen to most of us, if not all of us down the road, all of our customers certainly as they age. So income, confinement benefits, home health type benefits, then of course, any terminal illness benefit, we'll eventually get there as well. And then ultimately a death benefit. Now, if you were to look at the annuity marketplace and look at potentially positioning a product like that to serve each one of those needs, you would likely have to sell 3, 4, maybe 5 different annuities, except the Benefit 10 does all of these things in one chassis. So we're going to kind of talk about this, and this product was brought to Athene, as we know it today, from the old Athene Delaware days, and this was one of their best-selling products several years ago, and we've recently enhanced it by really improving the rates, the roll-up rates in particular, that I believe makes this one of the best sales for a couple of different reasons. And I'll share with you a consumer-approved sales concept at the end that I believe really helps sell this product to a lot of different folks. So with that, let's get into it here. And again, I mentioned sort of those benefits, but really there's 5 benefits in one benefit rider. Now notice I did not say an income rider, because this rider does a lot more than simply provide income, although it will do that as well. So again, that first benefit is lifetime income the client can't outlive. We have an enhanced income benefit, which we'll discuss, a confinement benefit, a terminal illness benefit, and of course the death benefit, which I mentioned last. And the concept I'm going to deliver to you at the end really focuses around taking R&Ds in a unique way from this product, and then again utilizing the death benefit as well. When that happens. So we'll get into the rest of the slides here. So we're going to kind of take these benefits one at a time. They're pretty intuitive, pretty simple to understand. But again, the great thing is that the client's not buying 4 or 5 different annuities. They're really doing one thing here, one purchase to solve a myriad of needs. So we'll tackle the income benefit first, and it's a pretty simple benefit. We'll talk about the roll-up rate here in a little while, but I think you'll be impressed with it. So the income is guaranteed for life. They can choose single or joint payouts. Again, like most riders out there, there's a level amount they can receive, and increasing and inflation adjusted. If they take income in contract years 2 through 7, we actually enhance the income they receive, and I'll give you an example of that in a minute. Now you'll notice the rider charge. It's 1.4%, and I think if you look at the competitive landscape, that seems a little rich at first glance. And I think if we were looking at a product that just had an income rider, I would agree with you. I mean, I think the average charge these days for a rider is, call it 80 bips to 100 bips, maybe 1%. Here we have one that's 1.4, but again, this is more than just an income rider. It's a lot more. And for this, you're getting 5 benefits, again, for the purchasing one rider. So I think it's a small price to pay for all that this will do for someone during their lifetime. And then again, when they pass away as well, for the beneficiaries. The great thing about this rider fee, though, is that at the end of the 10 years, this is a 10-year product, if for some reason the client hasn't earned enough value in the annuity to pay for that rider, it's free. So it's effectively a free rider if they make it 10 years and haven't earned the value. If they've earned the value, of course, it will come out. But again, I think it's a small price to pay for all the benefit they receive. So benefit 1 here, again, lifetime income they can't outlive. And we have this early enhancement I mentioned, years 2 through 7. If they trigger the income benefit in one of those years, we're going to increase the benefit they would receive, the income they would receive, by an additional 5%. So I'll give you a numerical example. We're going to come back to the same individual here time and again when we go through a few more examples here with the other benefits. But let's assume, for argument's sake, we have a $100,000 annuity. We're 66 years old at the time of issue. Our benefit-based interest rate, and I alluded to this earlier, is a 10% simple roll-up for the first 10 years. So keep that in mind. And we'll come back to that roll-up again in a moment. So if we wait 5 years, so now we're 71, we know that our payout percentage is 4.5%. We know because of our 10% simple roll-up, our 100,000 has rolled up to 140, guaranteed. Again, that's not indexing. That's the guaranteed roll-up rate at that level. You multiply 140 times the 4.5% payout percentage for that age bracket, and that generates an annual income of about $6,300. Well, because we're in that years 2 through 7, remember, we're going to increase that $6,300 by an additional 5%. So that increases their payment now to $6,615. So just a slight enhancement if they need to take income on the earlier side. So that's lifetime income. Number 2, a lot of words on this slide. I'll try to bottom line it for you. This is what we're calling our enhanced income benefit. Now, I'm going to describe this to you, and it's going to sound a heck of a lot like long-term care insurance. This is not long-term care insurance. I should probably bold that 3rd bullet from the bottom there, and I'll tell you why at the end here. But what this does is, if when the client's receiving income, and as long as they're after the 5th contract year and at least age 50, if they're unable to perform 2 of the 6 ADLs, activities of daily living, if those of you that are familiar with long-term care insurance terminology, on a permanent basis, we will increase their payout, their income, by 50%. So just when their costs are starting to increase because of, typically it's a home health care situation at first before it's long-term care or nursing home, but just when they need more money, we're going to go ahead and increase that by 50% to help offset those costs. Now, here's why I say it's not long-term care insurance. There's no underwriting to this, which is a great thing. Because there's no underwriting, it's not filed as long-term care. I will tell you this, if you put on the application when you submit it, one of the reasons you're selling this is for a long-term care alternative, we will reject it. So please refer to this as the enhanced income benefit. you see there at the top of the screen. So number one, we've got the lifetime income they can't outlive. Number two, as soon as they can't perform 2 of the 6 ADLs, we'll increase their income by 50%. So again, let's go back to that example. You remember that we started with 6,300, grossed it up to 6,615 with our 5% income bonus there for the early withdrawal. And then let's assume that in year 6, they can't satisfy 2 of those 6 ADLs. So we take their current payment, which is 6,615, multiply it times 50%, and now they're going to receive just under $10,000 for as long as they can't or are unable to satisfy those 2 of the 6 ADLs. So that's a powerful benefit. No extra cost. Again, that same fee that we applies to all these benefits, 1.4%. And again, no underwriting, which I think is huge. So that's benefits 1 and 2. The third benefit, let's go down the road. People are receiving income. The next step is typically some sort of long-term care situation. And then ultimately, many folks actually do need confinement situations or skilled care. So the next phase of this will cover that as well. So if a client becomes confined, again, the same parameters apply here. As long as they're over 50 years old and we're over 1 year old on the contract, they can't be confined when this is sold, by the way. That makes sense. As long as they're confined for 6 months out of a 250-day period, that's sort of like the elimination period, if you will, the entire remaining benefit base is liquid. It's paid out, however, over 5 years. That's a powerful benefit. Again, we know the contract is liquid, the value, but typically the benefit base, because it rolls up at 10% simple for the first decade, is a lot larger than what they've earned in the index. So to have that be liquid, even if it's over 5 years, is a huge benefit to the customers. So, keep in mind that the average stay in a home is typically 2-3 years anyway. So this is more than enough to do that. And again, these are checks that are sent to the customer, not the facility, so that they can use it for what they need it. And that same holds true for that 2 of the 6 ADL benefit as well. So income, we have the enhanced income benefit, the confinement benefit, and then of course the terminal illness benefit works very similar to the confinement feature. If the person is in fact terminally ill, as evidenced by a physician, any remaining benefit base is completely liquid over 5 years, or they can take a lump sum of that benefit base with a slightly discounted rate, 70% of that. And then the fifth and final benefit, everyone, is the death benefit. Again, as soon as they pass away, if there's any remaining rider benefit value, that benefit base is paid out over 5 years, or they get a lump sum benefit, the greater of their accumulated value, or effectively their benefit base discounted at 70%. So a lot of flexibility. Scott mentioned the term Swiss Army knife. This has something for everybody. We have clients that are going to use every single one of these benefits during their life. Yet we have some clients that are going to use this just for a legacy product. You can use this simply for a death benefit. Again, no underwriting there either. It rolls up at 10% for the first 10 years and continues to roll up, by the way, at 5% all the way up until age 85. I'll come back to that again in a second. So let's take a look at a death benefit example here. Again, that same individual, we're going to assume they're 66 at issue, gave us $100,000. We're rolling up their benefit base here at 10% simple each year. A couple years into it here, 4 years into it, they pass away. The benefit base is $140,000, we can see. So they have a couple choices. Option one would be to take all of that over 5 years. So in other words, $28,000 a year. Option two would be the greater of either their accumulated value, which in this example is about $104,000, or 70% of the benefit base, which would be $98,000. So they're going to get the accumulated value in that instance. But again, to get the entire amount, 140 versus 104, I think a lot of people are cash now in nature. Can't necessarily blame them for that. But in order to get the entire amount over 5 years, I think that's a huge benefit. I mean, that's in this example, $35,000, $36,000 more in benefit to the beneficiary. And think from a planning perspective, if you're the client who buys this, this is a great way to potentially stretch out the tax hit each year as well for the beneficiaries over 5 years. So let's talk about the roll-up. Generally speaking, nationwide, the roll-up is 10% simple for the first decade and then 5% simple all the way up until age 85. So now, believe it or not, this policy will issue as young as age 30. So think about that for a minute. If we cap the roll-up at 85, that means they're getting a 55 years of roll-up, 10% for the first 10 and 5% every year after that. There's not a lot of 30-year-olds, I guess, purchasing annuities, but just to illustrate the point, where else in the market can you get an income rider, a death benefit rider, a benefit-based rider like this that rolls up for as long as that? Typically in the marketplace, we see riders that are going to roll up for 10 years and stop. Occasionally we'll see a few like we have that roll up for 20 years, but 50 years of roll up, that's unheard of. So this is a great sale for even young folks that are planning their future, planning their long-term care needs, their death benefit needs down the road, see value and safety with growth. So that's a huge competitive advantage. So what I'd like to do, again, we're talking about deferrals here. What I want to do is talk about what happens to the benefit base when we start taking lifetime income withdrawals. Now, you've likely heard other companies, or even me, frankly, talk about this term pro rata, right? Most companies, most other benefit bases or income accounts decreased on a pro rata basis. And I'll give you a numerical example of this in just a moment. But I want everyone to make sure they understand this concept because it's important as it relates to this product. Now, in many instances, if we're talking about just an income rider, we don't care how it reduces because the benefit is not a real benefit, right? It only is there to determine how much money the client gets annually. They never get what's left, they just get the accumulated value. But when the benefit base is a real value to the beneficiaries, it's vitally important how we impact that benefit base when we take withdrawals. Most of the marketplaces reduces the benefit base via pro rata. And I'll show you that example in a minute. What we do on this product is take it out on a dollar for dollar basis. And what that does is allow the benefit base to last that much longer. Again, if it's just an income product, it doesn't matter. But when it's a death benefit as well, having that benefit base last longer, that's huge. So let's look at an example. Let's assume that in that same policy we had $100,000 and down the road we've accumulated up to $130,000. Let's say our benefit base though is $180,000, right? Again, that makes sense. 10% simple every year. Accumulated value is likely a lot less because the caps aren't as high as 10% for certain. Now the client triggers their lifetime income withdrawal at $9,000 annually. So your traditional product will take that $9,000 and say, okay, what percentage of that $9,000 goes into $130,000? In this case, it's roughly 6.9%, which means we're going to take not $9,000 from the benefit base, but 6.9% from the benefit base, which because the benefit base is much higher, it's a much higher number. In fact, in this example, the benefit base would have decreased by almost $12,500. With this product, that $9,000 comes out of the accumulated value. It comes out of the benefit base dollar for dollar. So you can see instead of having the reduction be $167,538 like you see there on the right, we actually have $171,000. So you can see that actually adds up more and more over time as well, that benefit base will last a lot longer. And that's important, again, when we're talking about a death benefit on the product. So we all know that we love talking about the roll-up rate, the benefit base, or the income rider value. You know, I'm sure you've seen clients or you've talked to clients about, we're going to take your $100,000, we're going to double it in 10 years, let's say, we're going to grow it to $200,000. You know, that's a highly marketable number. You know, 1 to 200, that makes a ton of sense. That's a great story. Key question to ask is how many people actually get to 200? And I would submit to you that if it's just an income rider, hardly anyone will get that all those dollars, because the first 100 is their money anyway, right? Because it's a real number with us, either they get it or their beneficiaries get it. We call this the TCB, the total benefit received. Total client benefit is the total income they receive when they're living, plus the remaining benefit base that's paid out to their beneficiaries over 5 years. And that's a huge deal there. Here's our state approval map here. Again, the dark blue states are the states that are typically your nationwide states. If you're in one of those red states, you know who you are. Annuity rules are typically a little difficult, a little more difficult than nationwide. Doesn't mean we don't have a version of this product for you. It just might work a little different. What I'd recommend you do is call the folks at IMES to get the information about the state that you live in there. Here's a quick look at the rates. You know, we do have a premium bonus on this as well of 6%, so that's great when you're considering rolling money over or 1035 exchanging. Again, the caps here, the caps are not what makes this thing sell. It's the benefit-based roll-up in the rider. I'm going to show you a client-approved piece here in a moment that I think will really open your eyes as to what this can do. So again, you can see the issue ages. Minimum premium is $10,000. It's a 10-year back-end charge. What I'd like to do is get into this piece here. And again, I want to reiterate, this is a client's approved piece now. So you can mail this out to clients. You can show it to customers on your meetings. Look at your book of business or look at your prospect list. How many people do you know that have to take RMDs? Obviously, that's a loaded question. You probably know a ton of people, friends, colleagues, clients, prospects that have to take RMDs. There's a ton of qualified dollars out there. And as you know the rules, once they reach 70 and a half, it's time to pay the piper. You have to start taking RMDs, whether you want to or not. So I like this piece because, again, client approved. It kind of talks about what an RMD is, why they have to take it, facts about RMDs here, and then why the Benefit 10 in particular is an attractive solution for RMDs. This is a perfect sales concept for a client that doesn't need the RMDs, but likes the idea of potentially leaving a legacy to their beneficiaries. By the way, I skipped over this page. What this does here is show the value of dollar for dollar reduction versus pro rata. I think it does it in a very client intuitive way. I'm a conservative person by nature, so I'm going to go right to the guaranteed only slide. So what that means is we're going to assume no interest credits from the index at all. I mentioned that dollar for dollar nature of the lifetime income withdrawals. What I didn't mention is that that dollar for dollar also works if a client takes RMDs. Now, that's not regular non-qualified withdrawals. It has to be qualified assets. If they take an RMD, we're only going to decrease the benefit base dollar for dollar, and that's huge. So let's see how this works. In this example, we have a 66-year-old individual with $500,000. Perhaps they're rolling this money from a 401k to an IRA. Maybe it's an IRA rollover, what have you, but it's $500,000 in this example. Now, we're not going to touch it. So this client is not buying this policy for the income rider. Sure, it's nice to have if they need it. It gives them that flexibility, but the point of the sale initially is to take RMDs and leave a legacy to a client or to a beneficiary. So effectively, for the first several years, because they're only 66, there's nothing coming out. You can see that here in the first 4 years, no RMD withdrawal. Let's go to year 5, though. We can see that our RMD is roughly $18,200. So we're going to start taking those RMDs every year for as long as we're living there. And you can see here what it does to the accumulated value. Makes sense. 498 dropped to 471. That makes sense there. Now, here's the big thing. The benefit base, because it rolls up in the first 10 years, it's still 10% simple. Even though we're removing that kind of money, we're still growing the benefit base by almost $30,000. And look how this works. Let's go at 9 years. Now we've received via RMDs almost $90,000 of income, of RMD income. Yet the benefit base is still growing, and that's $845,000. In fact, it's not until much later in life that the benefit base actually starts decreasing when the RMDs actually start outpacing that 5% roll-up I mentioned outside of 10 years. So let's go to age 85 here, and let's see what we've done and what we've received in income versus what's left. So at age 85, so we've been in this thing roughly 20 years. We've not earned a single dime in the market. Keep that in mind. This is all guaranteed. We've received roughly $250,000 in RMDs from our initial $500,000 investment. We've basically received half of it back. If we were to pass away, though, look what the beneficiaries received. $860,000, again, over 5 years, though. So for our initial $500,000 premium, on a guaranteed basis, we're going to get $250,000 out, almost $860,000 to the beneficiaries from there. That's over $1 million, $1.1 million of true client benefit from a $500,000 premium guaranteed. That's a powerful story. So again, just think about it as you look at your book of business. Who has IRA money, qualified assets? Who will be needing to take RMDs? This product does it better than most. And again, we have not even talked about underwriting because there is none. all of this for that 1.4% fee, which again, they get back if they don't earn enough to cover that after 10 years anyway. So again, I believe this is probably one of the more flexible products in the marketplace when it comes to true benefit-based performance guarantees. There's riders out there that'll give you a good death benefit potentially, maybe some income, but are they guaranteed and at what rate? This is not a participating rider. This is for your, perhaps your more risk-averse people that love the idea of guarantees they can take to the bank. So, Scott, with that, that's all the prepared remarks that I have. We did cover quite a few features in a relatively quick amount of time. So if there's questions or, by all means, if you want to finish your content, I'll let you take the control back from me and off you go.
I am not going to, I'm sure many of our webinar attendees were very happy that I didn't have the normal introductory there, so I won't go back into my spiel, and also fear that my frog will come back. I don't know what happened there, but a couple things I do want to hit on so that everybody is aware before I do get into the questions. Mac, one, I want to make sure everybody knows about the IMS Marketing Summit. Very excited about this. Mac attends most of our large advisor events, so he can tell you, Steve and Charles, our ownership group, spare no expense. We are still qualifying. Qualification will go through the end of June 2019. 3 million trip credits will get you there. You can see a breakdown of how we calculate those trip credits. We will be in Naples, Florida at the Ritz-Carlton. Amazing facility. It's going to be an amazing trip. If you'd like to know where you stand, I do have numbers calculated through the end of November. So let me know that. Also, if you'd like to have a conversation about what we can be doing to help you get over that 3 million trip credit threshold, please let me know. Certainly would like the opportunity to help you there. All right. Oh, the other thing I do want to mention, I didn't get the slide put in, Mac, mea culpa on this. Athene has been kind enough to partner with us for what we are calling the Sweet Escape. We are going to take our top 20 Athene producing agents in, is it February, Mac, that we're doing that? I don't have the dates in front of me.
So I believe the premium parameters goes, I want to say even into March, Scott. I believe the travel dates are early April for that, or late April for that. So,
okay.
Yeah, so you have, so I know that we retroed that qualification back a month or two, which is great for everybody that hasn't heard about it yet.
Yep.
And again, it goes through, I think, at least Q1. So, look, we'd love to help run your business, and you get to go on a great meeting event and trip like Scott just mentioned as well down the road. I believe we're going to San Antonio.
Yep, we'll be at the brand new JW Marriott facility in San Antonio. Got 2 amazing golf courses on property. It's about 15 minutes to the Riverwalk in San Antonio. I believe it's about 20 minutes to the Alamo. Just a really neat area to be. Should be an extremely good trip. Anybody that is there can watch me get humbled. Mac will beat me so badly on the golf course that I'll be crying at the dinners. I know everybody looks forward to that. So, but we are very excited. Athene's a great partner with us on that. So if you'd like more details on that, I can certainly get those for you. Mr. Campbell, are you ready for a couple of questions?
I am. Let's go. Yep.
So the first one that came in has to do with the acceleration for not long-term care, but assistance with costs should the individual, did I cover myself well enough there?
Perfect.
I'm just going to read it verbatim. To sum up, the individual does not qualify for the accelerated benefit if they have cognitive impairment, but must be confined to a long-term care facility.
Let me hold on. I want to make sure. Are we talking the enhanced income benefit or the confinement benefit? Could you ask that one more time, Scott? I'm sorry.
Sure. I think we're talking about a little bit of both. I'm not sure if they recognize that there is an enhancement option available for the income stream or an acceleration for confinement. Can you break down the difference between the two for us just real quick again?
Absolutely, yeah. And I apologize if I didn't make that clear or more clear. So, yeah, it's two separate benefits. So the first benefit, I mean, most people, and this is a bit of a generalization, but I'm speaking from my own personal experience with my grandparents. Most people, before they go into a nursing facility, typically experience some sort of care in the home, or maybe it's assisted living or something like that. And what we've done here is provided a benefit that it doesn't matter where they are. They don't have to be confined to a facility that exercise this benefit. As long as they're unable to perform 2 of those 6 ADLs on a permanent basis, we will increase that payment up to 50%. Now, we reserve the right to check in on them every 2 years to make sure they're still unable to perform those. But assuming they're not able to perform them, this benefit goes as long as they're not able to do that, which is a huge benefit. Again, no underwriting there, no extra cost from what we already talked about. If the client does become confined, they have the ability to basically make the entire benefit base liquid and payable over 5 years. Does that help, Scott?
Yep. I think you nailed it. So I appreciate that clarification. So in the example, and I can't, we got the benefit base up to $860,000. Do you remember the example?
I do.
So,
I do.
Question came in: is that $860,000 taxable?
Yeah, I mean this is not life insurance. Again, just like I mentioned before, how it's not long-term care. There's no underwriting here, folks. So this is an annuity through and through. So it would be taxable to the extent of what's not basis, right? So it'll be last in, first out. So I think in our example, again, I'm bringing it back up here, we've received, call it $250,000. I guess in theory, there's still $250,000 left of basis. So most of it would be taxable. But again, taxable at the beneficiary's income tax rate as well. So let's remember that. This is a death benefit. And then eventually, again, it's as long as if there's some basis left, then that would be not taxable.
Fantastic. Thank you for the clarification on that. And we had one final question come back in just to reiterate this. Basically, the question just says, did I hear that the client gets the rider cost back after 10 years? Can you give us some clarification on that?
Yeah, no. And actually, you know what? I'm gonna recant my last statement. We're talking qualified dollars. It's all taxable. That's my mistake. Sorry about that, Scott.
Sure.
For the RMD scenario, that's IRA money. Those are taxable dollars to the beneficiary as well. But again, still a great deal. I mean, we're talking a ton of money here that's guaranteed. So in reference to the charge, if the policy, if they earn enough value in their index over that decade to pay for the rider, then they're going to pay for the rider. And again, I think that's money well spent, given the guaranteed growth we've just discovered here. However, if in 10 years, maybe the market has a protracted period of growth and it's just not outpacing the cost of the rider, if the client has not earned enough value in 10 years to pay for 10 years worth of rider, then it's basically free. We'll pay for the rider at that point. So if they're earning value, then they pay for it.
Fantastic. As Mac alluded to, it's a great deal. I was going to say this in my introduction, but obviously I lost my throat there. I truly believe in this product. It is a great value proposition for clients. Great enough value proposition that I've sold one of these to both of my parents. Own it. Great product here. I would highly encourage you, if you haven't given the Benefit 10 a long, hard look, to do so. There is a lot of value proposition. Both of my parents' qualified funds or 401k rollovers are currently in the Benefit 10 product, and I believe that my brother and I will be happy about it long term. So a lot of value there, and they are happy about it currently. That being said, that brings us to the end of our presentation today. So I do want to thank each and every one of you for taking the time to join us. Mac, do you have any parting words for the group?
Well, again, just thanks for your time today. I know it's a busy week for everybody, you included, Scott, and just have a great, safe happy holiday season to everyone, and we'll look forward to working with everyone as the new year approaches. Thanks again.
Absolutely. Thank you so much for your time, Mac. We do greatly appreciate it. Go out, have a great sales day, everyone. I look forward to speaking with you very, very soon.